generally, it has outperformed, as you pointed out, virtually every other type of commercial real estate, from industrial, office, retail, residential, healthcare, all of them, over a long period of time, 3 decades. It's just a solid performer. There's a certain simplicity to it, yet the demand for storage is growing.
Welcome to the Opportunity Zones podcast. I'm Jimmy Atkinson. Self-storage has been one of the top performing real estate sectors in recent years. In fact, self-storage was the top performing property type in the NAREIT index, with average annual returns of 17.3% for the 30-year period from 1994 through 2023. And although conditions have normalized from the peak levels of the pandemic, there are still plenty of structural demand drivers that may produce outsized returns in the sector for years to come. Today's guest is President and CEO of YourSpace America Self-Storage, Russ Colvin, joining us today from Ladera Ranch, California. Russ, thanks for coming on the show. How are you doing?
Thank you. It's always a pleasure.
Always a pleasure having you on the show as well, Russ. And right before we hit record, you mentioned to me that you're excited to talk about your favorite topic, which is self-storage. Right. So I'm really glad to have you on here. No one knows more about self-storage than you, in my circle at least, Russ. And you know, for my listeners out there, a lot of you may be familiar already with Russ and his firm, YourSpace America. They have been featured on my OZ Pitch Day platform multiple times now. So you may be somewhat familiar with Russ already. But Russ, for those who may not know of you, maybe this is their first time hearing about Russ Colvin and YourSpace America Self-Storage. Can you tell our audience a bit more about yourself and your firm, YourSpace America?
Yeah. So I have spent my entire adult life around commercial real estate. For 22 years, I was on the lending side. I ran several lending operations for commercial real estate. And of course, that was a great training, if you will, for commercial real estate. And for the last 20 years, I've been on the investment side. And of that 20 years, the last 11 years, I've been on the self-storage side. And I only wish that I had begun investing in self-storage sooner, because as you point out, it is the top performing product in the NAREIT index and generally outperforms all the projects that I see out there and other product types. We formed YourSpace America in 2021 because we, as an investment manager, wanted to bring returns to private investors that generally are received by institutional investors. And my track record over the last 12 years has, I think, been very good. I think it averaged about a 39% IRR, which overall is higher than you see in almost any other product type. And what I wanted to focus on was holding projects a bit longer, maximizing returns for investors, especially on opportunity zone type of projects. And of course, realizing the tax benefits for investors as well. But again, bringing institutional level returns to private investors, allowing private investors to invest like they're, BlackRock, if you will. So
no, that's tremendous. I want to ask you more about, who's investing in self-storage and why it's opened up to that smaller, more Main Street investor a little bit later in today's episode. You mentioned that you and your partners started YourSpace America just a few years ago in 2021, but you have a much longer track record than that in commercial real estate and self-storage, right?
Yeah, I was CEO of Core Realty Holdings from basically 2005 to 2009. I was president of Mammoth before that. And in Core, from zero, we created about a $1.2 billion portfolio of multifamily and industrial. And then from 2015 to 2020, I was CEO of North American Self-Storage. And we had a number of very successful projects throughout the country, from Massachusetts to California. And I often have people say to me, well, have you had any projects that didn't do well or didn't perform well? And the answer is no. And that in part is because I have a nickname around the company. I'm called Dr. No. And I basically am very choosy about projects that we invest in, because as the old saying goes, the easiest problem to solve is the one that isn't created. So if a project doesn't check all of the boxes, as I tell everyone, we're not interested. So, we have high standards in terms of what we invest in, and, the record has shown that that's a good policy.
All right, I want to ask you about what those boxes are in a few minutes here. We'll get into your investment thesis and which markets you like and all of those boxes, right? But first, I wanted you to just zoom out for me a minute here, Russ. I'd like to know a little bit more about self-storage. We actually haven't really covered self-storage on the first 300 plus episodes of this podcast. A lot of talk about opportunity zones in general, a lot of multifamily developers who have come on and talked about the multifamily market in their different locations, but we haven't really talked a lot about self-storage. So I'm just curious, can you give me a brief history of the self-storage market, and specifically what's transpired over the past 5 years and what's the current state of the self-storage market?
Well, over the past decade, an increasing percentage of the American people use self-storage. We tend as a people to hoard things or to keep things around and not have enough space for them. Many people use storage for any number of issues. And it's also a product type that people use when they have issues like they're getting a divorce or they're going to college or they're moving or they're downsizing or whatever. They need self-storage. And as I say, the demand for self-storage continues to increase, while at the same time, we see an increase in the number of businesses that use self-storage because it's also very convenient for them. So if a business needs, 100 square feet for storage or 200 square feet, or they need 100 square feet today and they're going to need more as time goes on, they tend to be very good customers because they move in and they generally stay for a long time and they generally expand. So as I say, demand from individuals and also from businesses. And, that is something we look for in markets where there's undersupply of self-storage. It's also, if you will, one of the reasons it does quite well and it's popular is because it's fairly simple to operate, in that you can generally operate a facility with 1 to 2 employees. So if you have a quality facility, the break even is lower than in most other types of real estate. So that is also another benefit to self-storage investment. But overall, generally, it has outperformed, as you pointed out, virtually every other type of commercial real estate, from industrial, office, retail, residential, healthcare, all of them. And as you also pointed out, over a long period of time, 3 decades. So it's not, and as you mentioned, we'll get into more who's investing in it, but it's just a solid performer. There's a certain simplicity to it, yet the demand for storage is growing. We also see a demand for high quality storage. So what we develop is, Generation 5 facilities, high quality facilities. About 2/3 of the people who make the decision to use storage are women, and they want a clean facility that's secure, that's well lighted, so they can go there anytime they choose and feel safe. And that's something that we offer. We also develop those type of facilities because it's something that institutional investors are seeking as well. So when the time comes eventually to sell a property, we want one that everybody wants to buy. That's the ideal situation. So, great projects and great markets where there's demand. It's relatively foolproof if you stick to that.
If you stick to it, exactly. I was reading a little bit of research on self-storage earlier today before we started this interview, Russ, just so I get caught up to speed a little bit. I saw a report from Cushman Wakefield. I was looking at a Yardi Matrix report. I was looking at a CBRE report, and they all seem to indicate that self-storage has experienced a pretty good amount of growth over the past several years, but it really spiked during the COVID-19 pandemic, and since has normalized a little bit. But as I mentioned in the intro, there's still a lot of structural tailwinds. Is that correct?
Well,
Is that how you see it as well?
absolutely. That is a great point you just made. Self-storage is also a product that performs very well in difficult circumstances. So during the Great Recession, it outperformed other product types. It also had the lowest delinquency rate of any kind of real estate. In fact, it continues to have the lowest delinquency rate of any type of real estate, even lower than mobile home parks, less than 1%. There's nothing else like it. And during the pandemic era, which is basically 2020 through June 30th of 22, it again way outperformed every other type of real estate. So yes, in that sense, since then, and the rents went up quite a bit during that time as well. And since that time, there's been some softening in terms of rents, but the general consensus in the industry is that as rates continue to fall here in the near future, hopefully going into 2025, that we should be in a very good climate to see self-storage rates going back up, cap rates going down. It should be a very good time for self-storage.
Well, let's hope so. Opportunity zones. Speaking of opportunity zones, you have a number of different self-storage projects that you've developed over the past few years, and some that are ongoing right now in development that you're raising capital for. They're not all in opportunity zones, but you do have a fair number that are located in opportunity zones. Do you feel like the opportunity zone tax incentive is ideally suited for self-storage development, or is it more a matter of some of your locations just happen to be slotted in opportunity zones and
well, that's a great question. So we have presently opportunity zone projects in the Las Vegas market, the Tucson market, and the Phoenix market, and I believe really in some very exceptional locations. Like, for example, we have one in downtown Phoenix, in an area that in the last few years has experienced some phenomenal growth, and there's a need for storage there. Most of the product there is older, so we're going to an opportunity zone and developing a project that will be the best project in the area. And given its location, everybody in that area that comes in and out of downtown or that lives in the downtown area around there will know this property because of its location. So when I look at the returns that we are projecting, assuming a 10-year hold, it really outperforms any other thing that I'm looking at. Like, for example, on our Phoenix project, we're estimating about a 24% annualized return to investors. And then, of course, there are the depreciation benefits, and of course, you hold it for the full period, which we plan to. There's no tax on the gain. It really is a great investment deal for investors to do a long-term hold, which I like in self-storage, and maximize their returns. Same story on our Las Vegas and Tucson, really just great locations, similar returns. And we plan to hold those for the 10 years and realize those returns and all the other benefits as well. And of course, the other thing about opportunity zone projects, in addition to no tax on the gain, is that there's no recapture on the depreciation. So, all of that depreciation you take during that period of ownership, there's no recapture when you go to sell the property. So it really is a great investment vehicle. And as I say, I think self-storage is the best property type for opportunity zones.
Yeah, why do you say that? Maybe you can compare it to some other commercial real estate sectors. How does it compare?
Regularly, I do look at other types of real estate and what kind of returns that they're generating. And we hear this from people also all the time. that, the level of returns that we're talking about are higher than other project types or product types in commercial real estate that people are looking at. So they're looking at multifamily or industrial or retail, office, various product types, and none of them have the level of returns that you have in self-storage. But the other thing you have in self-storage too is it is now considered a safe harbor investment type. So it's right there with multifamily in terms of safety for investors. So it's something they can invest in and generally, hopefully, not have to worry about how their investment is going to perform. Over a long period of time, it should perform very well. And as I say, with ongoing demand for self-storage, it's a product type that people need. Even during the pandemic, it was a product type that people could access. People were allowed to go to their storage facilities. So, as I say, it is a great product type for so many of those reasons that I just mentioned.
Yeah, I wanted to look at the Novogradac survey results, and their most recent survey results report is as of the year end of 2023, so through Q4 of 2023, and they break down by product type as best they can. A lot of these funds, the reporting's kind of tough because oftentimes they'll invest in multiple product types. And also Novogradac doesn't break down within commercial real estate quite as granularly as I might like. I'd like to see like industrial versus retail versus office versus self-storage, but they do have residential versus non-residential commercial real estate. And according to that most recent report from year-end 2023, or through year-end 2023, I should say, over the lifespan of opportunity zone investing through year-end 2023, residential only qualified opportunity funds have raised nearly 4 times the amount of OZ equity as commercial only qualified opportunity funds. And self-storage is really just a very small part of that commercial slice overall, because it also includes, as I mentioned, industrial, retail, office, et cetera. Russ, are developers and investors missing out? Are we building too much? Are we developing too much? Are we investing too much in opportunity zone multifamily and other forms of residential? And are we not building enough self-storage?
Well, obviously,
what are your thoughts there?
there's more need for multifamily than storage. But I do see in markets throughout the country that we look at, monitoring the development in opportunity zones, that there doesn't seem to be a great deal of development in opportunity zones, and there should be. And I think part of it is due to the fact that a lot of developers aren't really in tune to opportunity zone type of investments. But as I say, when I look at the comparison between self-storage and these other product types, there is no comparison. And we've had people tell us, oh, we don't see many self-storage opportunity zone deals. So they were, they're happy to find one.
But that's what I tell people too. I say
Yeah.
there really aren't a lot of self-storage OZ developments out there. I always point them to YourSpace America. You guys, to my knowledge, are the only ones that I know of that are doing self-storage development in OZs at the level that you are. Do you know why there aren't more?
I don't know exactly. I think it's just in large part due to the fact that a lot of the developers just aren't in tune to the benefits of op zone investing for investors. I think I've talked to a lot of self-storage developers, don't know anything about it. So I think the problem is mainly just a lack of knowledge about opportunity zone investments. And let's hope it stays that way. Just kidding.
Well, for your sake, right?
Anyway, but we're very excited about our op zone projects and the locations and the future for those projects, and the level of returns that we hope to make for investors. Something on the order of about 4x. So if somebody puts in $1 million, they should make a profit of a little over $3 million during their ownership, and then it's not taxable. Plus the depreciation benefits with no recapture. I mean, In fact, when our attorneys first talked to us about opportunity zone projects, I kind of joked with them. I said, "You sure this is legal?" And yeah, of course it is. But it is a great benefit to investors, and hopefully they take advantage of it wherever they can.
Yeah, it almost seems like it's too good to be true when you first start hearing about opportunity zones, the tax-free profits after 10 years.
Yeah.
Plus, as you mentioned rightfully a couple times here already, Russ, is depreciation recapture gets completely eliminated as long as you do you do everything by the books and you stay in compliance, which is a huge benefit that gets often overlooked.
Right.
Well,
No, that's a huge benefit.
For sure. You mentioned a little bit earlier the three markets that you're in with the three opportunity zone markets that you're in: Las Vegas, Nevada, and then two markets in Arizona, Tucson, and then Phoenix, which you're right downtown in Phoenix, just adjacent to the Arizona Diamondbacks
Stadium,
ballpark, right? Yeah, the Diamondback Stadium. Can you tell me a little bit more about those opportunity zone investment projects?
Yeah.
Maybe you can go
So
through each one by one, and what stage of development they're in, and what your overall OZ investment thesis is for each of those products.
Well, in the case of, let's start with Phoenix. As you mentioned, that's a market where the project is strategically located. It's about 650 feet from Diamondback Stadium. It's about 300 feet from 7th Street, which is a major arterial in and out of downtown Phoenix. It's going to be a 50-foot tall building. So when it's completed, as I mentioned, everybody in the area will be aware of it. There is a newer public storage facility not far away. But other than that, most of the supply in the 3 and 5 mile radius is older properties. A lot of it non-climate controlled. And of course, in Phoenix, as we know, it gets pretty warm. So people want to protect their valuables. They want, climate controlled storage. And as I said, this is going to be very recognizable property, perhaps the most recognizable in downtown Phoenix when it's completed. And of course, we're projecting, as I mentioned, about a 24 IRR on average and about a little over a 4x level of return. So, we're very excited about that project. We are just about ready to begin construction. That should start in about 45 days. Then we have a project in Las Vegas on Owens Avenue, which is literally adjacent to Interstate 15. And again, that's going to be a high recognition project. The site's about 30 feet above the interstate, and the building is going to be about 50 feet. So we're going to have signage at the top of the building, which will be 80 feet above. And the city's also allowing us to put in an 80-foot sign on the property. So we've discussed the fact that when this is completed and we have the sign, we have the building there, this will be probably the most recognizable self-storage facility in the Las Vegas market. And you have, 177,000 vehicles per day on Interstate 15. So again, that's another property that everybody in the market will be familiar with. Similar level of returns. And then we have a project in Tucson, which is literally located on a freeway on-ramp to an interstate highway. And in fact, when we had the appraiser appraise the project, when we were acquiring the land, he told us he thought it was going to be the most recognizable facility in the Tucson market. So it's right on the interstate highway. It's going to be about 50 feet high. And directly across the freeway from the property is about 1 million square feet of power retail. So, all the thousands and thousands of people that go to those retail centers across the street are going to be familiar with the property. The people that travel along the interstate highway are going to be familiar with it. Again, and we talked about checking the boxes. Those are the kind of things that we look for. And again, all of them are in undersupplied markets. So there's not an issue of, we're building storage and there's a lot of new supply coming in, or there's oversupplied currently. as I mentioned, that's something we look at. So between the locations and the markets, they're all, in addition to that, if you look at the Phoenix story, the Las Vegas story, the Tucson story, these are all growing markets where the population is growing. Just for a quick example, in the Phoenix property, within a 5-mile radius of the property, there are 17,000 residential units in planning or development. And if you assume about 3 people per unit, that's about 50,000 people, that'll be added. So it's an area where there's a lot of growth going on. A lot of people need storage. A lot of universities in downtown Phoenix that need storage. A lot of businesses that need storage. They are building a lot of multifamily downtown Phoenix. So that just gives you an idea of demand drivers that we see in that market. And in the Las Vegas project, it's a pretty undersupplied market. In fact, when we got approval from the Las Vegas City Council, they were very excited about it. We need storage there. And then in Tucson, we spent about 2 years getting the change of zoning to allow self-storage. The city very strongly supported it, felt like they needed quality self-storage right there. So as I say, you have all those individual customers, but you're surrounded by businesses as well, and many of them will need the storage.
Yeah, Russ Colvin, you mentioned that you've got the nickname Dr. No. I did want to talk with you about the checking off those boxes. So I'm picking up a pattern. You kind of laid them out for me, but you like to go into areas or locations where there's an undersupply of this product, where there's growing demographics. They're all located in the Southwest. Is that a box that it needs to tick, the southwestern part of the country, or is that just nice to have?
We like the Southwest. I have done projects in the East. I've done 4 in Massachusetts. I did one about 3 years ago in the New Jersey market, done in other markets, the Midwest and so forth. But there's areas in the Southwest that have some good stories. But, we're open to projects. We're just working on one in Dallas right now. We also have a project in Houston, and Houston certainly checks the boxes in terms of population growth in this particular location, undersupplied. In parts of Texas, definitely check the box. So we like that market as well. But we're anxious to go anywhere where, we can check all the boxes.
And then another box that it seems you like to check is a site that has very high visibility, either right off of a major thoroughfare, an interstate highway, or right downtown off of a major arterial street. That's got to be one of the boxes too, right?
Yeah, definitely.
Are there any other boxes we're missing?
Visibility is, I think, very important and something that we certainly look at. So again, you're right. That's something we definitely look at, is wanting to be in areas where we have high visibility, where it's recognizable. And about 80% of people find their storage online, but you still have a lot of people that will recognize it. If they see it online, they'll know where it is, they'll come to it, or if they're just thinking about storage, they can drive right to it. And again, if you're in an area where there's a lot of businesses around, then they'll know where it is as well. And if you have climate control, again, that's another driver, because people want to be able to put their valuables in somewhere and have them be safe. In fact, we have a lot of businesses that use self-storage to store their electronic records. So a lot of companies will come in and they don't want to leave them in a regular storage facility. They want to put them in a safe place. They want a climate control, so they'll come and rent a unit and keep those kind of records in a self-storage unit. We see that quite a bit, actually.
Right. I don't want my computer equipment or my hard drives sitting in an air-conditioned storage facility where it's going to reach 120 degrees outside if you're in Vegas.
Exactly. You don't want that.
Right. I want to talk about the capital base typically, or the investor base typically, for self-storage. I think it's, correct me if I'm wrong, I think traditionally it's been an institutional type of investment opportunity, but as time has gone on, there's a lot more access to these types of products for smaller investors, Main Street investors. Is that right? Who is the typical investor in self-storage assets, and who are the typical investors in your deals?
That's a great question. So we have had institutional investors that have invested with us. I actually prefer dealing with individual investors. As I mentioned, I like the idea of bringing institutional level returns to private investors so they can realize the same kind of benefits that institutional investors are realizing. But when you talk about self-storage and institutional investors, that's a great subject, because if you look at, for example, let's take Public Storage, the largest self-storage company in the world, about a $50 billion market cap. And you look at, okay, who are the top shareholders there? You've got like Vanguard that maybe owns $6 billion worth of their stock, BlackRock that owns maybe close to $5 billion. And you got household name investors from JP Morgan to Charles Schwab. All those kind of people are among the top 10 investors. And those top 10 investors own well over $20 billion worth of the stock. Okay. So if you take an investor like BlackRock, like the largest in the world, right? So if they have a $5 billion position in a company, they must feel pretty good about it. And if you look at, say, Extra Space, the number 2 self-storage company in the world, you have the same thing. You have about the top 10 investors own about half of the stock, and they're all institutional, from JP Morgan to Vanguard to BlackRock. So these are institutions that if they're going to make that kind of investment, they want to know that their capital is safe, and they want reliable levels of return, and that's something that self-storage provides. We also see that a growing number of institutional investors, even the Harvard Endowment, invests in self-storage. State pension plans, people that want a safe investment are increasingly going to self-storage.
And access has become much more democratized, right? Over the past, I'd say 10 to 15 years or so in particular. And, your platform giving access to this product type to that smaller investor. Not that you're a super tiny investor, but you might just not quite be a State Street or a Vanguard or a BlackRock or a CalPERS, right?
Right.
But maybe you have $100,000 or $1 million to place, and you're able to bring in those types of investors, right?
Well, yeah, that's a great point. So we have people that might want to put in $1 million, $2 million, $3 million in a property. And then we have a few investors that want to put in 100,000. We have a handful that want to put in like 25,000. So, people that make those investments, they can achieve, whether you're putting in 25,000 or 3 million, you're going to get the same level of returns, right? When you can't really say that if it's an institutional investor, obviously, right? But I think it is a great opportunity for smaller investors to, as I've said, get institutional level returns.
Yeah, it's a great story. It's a great broader story that we don't have the scope to go into on today's podcast episode, with this story of democratized access to alternative investment structures and alternative investment types, like real estate, and in this particular case, like self-storage real estate. Russ, it's been great speaking with you today. We're kind of winding down our time, but just wanted to ask you a big, broad question kind of to cap our discussion today. Are there any big trends just overall in commercial real estate investing that you're keeping an eye on?
Obviously, we're looking forward to 2025 in self-storage. We think that's going to be a great period. A number of our projects will be opening at that time, and we think we'll see some very good rent growth. Industrial continues to do relatively well. Multifamily's off a little bit. But I think, again, in commercial real estate, you need to be cautious about what sector you're in. I don't think I'd want to be in office or retail. But, there are several that are doing well, and then several you need to keep an eye on, I think.
Very good. Well, before we go, where can our audience of Opportunity Zone investors and advisors go to learn more about you and YourSpace America self-storage? What's the best way for them to learn more about your company and get in touch with you?
You can go to our website and we'll direct you to contact us. You can also email me directly or phone me directly, and I think that information is available. And I very much enjoy talking to investors. So I tell people you can call me any time of the day or night. Always like to make myself available for investors so we can talk about self-storage.
Very good. We'll make sure to link to Russ's email address and website in the show notes for today's episode. That website URL, by the way, for Russ's firm is yourspaceamerica.com. And then Russ Colvin's email address, I'm going to read it out loud for everybody here, and we'll also link to it in the show notes, Russ. It's Russ Colvin at yourspaceamerica.com. And for all of our listeners and viewers out there today, we will, of course, as we always do, have show notes available for today's episode on our website at OpportunityDB.com/podcast. And we'll have links to all of the resources that Russ and I discussed on today's show. And also, please be sure to subscribe to us on YouTube or your favorite podcast listening platform to always get the latest episodes. Russ, it's been a pleasure. Thank you so much for joining me today.
Thank you very much.